Imagine a government so desperate for money that it starts printing promises on paper, hoping people will treat them like gold. At first, it works. Shops accept the notes, soldiers get paid, and the kingdom seems rich again. But soon, trust cracks. Prices rise, fortunes vanish, and angry crowds fill the streets. This isn't a fairy tale. It's France in the 1700s, a nation buried in debt, turning to paper money and stumbling into revolution. To understand how paper promises helped break one of the greatest kingdoms in history, we need to go back. France in the early 1700s was powerful but broke. Decades of wars had drained the treasury. The Sun King, Louis XIV, had built Versailles, fought rivals across Europe, and left behind a mountain of unpaid bills. His heir, Louis XV, inherited not wealth but debt. In desperate times, desperate ideas take hold. Enter John Law, a Scottish gambler turned financial visionary. Law convinced France that paper money could solve its problems. Instead of relying only on gold and silver coins, the kingdom could issue paper banknotes. These notes, he argued, would grease the wheels of trade, speed up business, and make France rich again. At first, the plan worked. Law created the Banque Générale, a private bank that issued paper notes backed by royal authority. People loved the new money. It was lighter than heavy coins, easier to spend, and it made the economy boom. To fuel the system, Law tied the notes to shares in the Mississippi Company, a trading venture promising vast riches from French colonies in America. Speculation went wild. People lined up to buy shares with paper money. Paris buzzed with talk of fortunes being made overnight. The streets outside Law's bank overflowed with crowds, desperate to trade coins for notes, notes for shares, and shares for dreams of wealth. But here's the problem. Those dreams rested on nothing solid. The Mississippi Company promised riches that didn't exist. The paper notes multiplied faster than the gold and silver behind them. In other words, France was printing wealth out of thin air. At first, the illusion held. Land prices soared, merchants thrived, and the king praised Law as a genius. But the trick depended on one fragile thing: trust. If people believed the notes were as good as gold, the system worked. If doubt spread, the whole machine collapsed. Doubt came quickly. As more notes flooded the market, prices of everyday goods rose. Bread, wine, cloth all cost more. Ordinary Parisians began to notice that their money bought less each week. Whispers spread. Maybe the paper was worthless. Then panic hit. Investors rushed to exchange paper notes for real coins. But the bank didn't have enough metal to cover the promises. Law tried to stop the run by limiting how much gold people could withdraw. Instead of calming the panic, it fueled anger. Crowds rioted. The bubble burst. Overnight, fortunes vanished. The Mississippi shares collapsed in value. Paper notes became scraps of worthless paper. Shops refused them. Families who thought they were rich found themselves penniless. France's experiment with paper money ended in disaster. John Law fled the country in disgrace, but the damage was done. Trust in the monarchy's finances was shattered. Debt remained sky high. Ordinary people who had lost savings and faced rising prices grew bitter. This failure wasn't just a financial story, it planted seeds of revolution. When the monarchy later tried to raise taxes to cover its debts, the public refused. Memories of being cheated by paper money were still fresh. Why should they trust the king again? The 1700s rolled on and France's debt only grew. Wars with Britain drained resources. Extravagant spending at Versailles fueled resentment. By the time Louis XVI took the throne, the kingdom was on the edge of collapse. Attempts at reform failed. Ministers proposed new taxes, but the nobility resisted. The poor, crushed by high bread prices, erupted in anger. By the late 1780s, the state was bankrupt. And when the king called the Estates General to raise money, the people instead demanded revolution. Paper money returned in the revolution itself. The revolutionary government issued assignats, notes backed by confiscated church lands. At first, they seemed like salvation, just as John Law's notes had decades earlier. But the same trap repeated. Too many notes were printed, inflation soared, and once again ordinary people paid the price. France's paper money saga shows a brutal truth. Money depends on trust. When governments print too much, when promises outweigh reality, collapse follows. The French people learned that the hard way, and the fallout shook the world. The revolution wasn't caused by paper money alone. But the failure of trust in France's finances was a spark. People had lost faith in their ruler's ability to manage debt, to manage money, to manage the kingdom itself. And when faith dies, revolutions begin. Why should you care about a financial disaster from 300 years ago? Because the pattern is timeless. Paper promises can fuel growth, but if overused, they backfire. Inflation isn't just numbers, it's the quiet theft of wealth. Debt isn't just accounting, it's power and politics. And trust, once broken, is almost impossible to restore. France's 1700s paper money experiment ended with riots in the streets and a monarchy toppled. Today, nations still rely on debt and central banks printing money. The question is, have we really learned the lesson? Or are we repeating the same dangerous trick, only on a larger stage? History doesn't repeat, but it rhymes. John Law's paper notes, the assignats of the Revolution, the financial bubbles of modern times, they all tell the same story. Wealth built on promises alone eventually collapses, and when it does, the people pay. Paper money can buy time, it can buy wars, it can buy palaces, but it cannot buy trust forever. France's 1700s debt disaster proves that once faith in money breaks, revolution is never far behind. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.